So welcome everyone. We have a lot to talk about. Definitely, tonight it's going to be, this afternoon or this morning, just depending where you are. I'm going to do a breakdown what's happening with inflation on the US, why the latest inflation data came in lower than expected, and how this is affecting the financial markets and especially the Forex market. I also am going to talk about the CME FedWatch tool that is now pricing in only 2 rate cuts despite the slower inflation print last night. And then finally, we will discuss some growing fears of the potential recession on the US that a lot of people are talking about. And what can we do with that, So we have a lot to cover. But before we go any further, as always, I need to put the risk disclaimer. Sorry, I forgot to read that. So we're going to be looking at understanding inflation and why it came lower. How does this affect the market in a general view? As well, why is the CME FedWatch tool now pricing in only 2 rate cuts? For those who don't know, CME FedWatch tool, I think that says pretty much. So CME is the Chicago Mercantile Exchange, Chicago, whatever. And that is a gauge. It's not like it's like an indicator, and just like any other indicator, you can't put all the the expectations on the indicator to work 100%. It's just an indication. Indicator comes from indication, right? So it's an indication that something can possibly happen in that period of time. And why is that only pricing 2 rate cuts now? And then recession fears are rising, and we are heading for an economic slowdown. Maybe, no. Well, that's what I'm gonna cover tonight as well. And what should us do? What should traders like us do? And what should we watch next? Because there's definitely a lot of things going on around the market at the moment. Okay, there you go. Come back to this one. So understanding inflation, why it came lower. So first of all, let's have a look at the FinLogic's economic calendar. On FinLogic's, of course. So for those who don't know, FinLogic's is a sister company from ACY Securities, and they provide data to the market. Okay, pricing, charting tools, indicators, everything here is perfect. So just type it up, finlogics.com, and then the website will come up, or you can simply click the link I will send on the chat. Logics website. Perfect. Send over there. You can come into tools and then click on economic calendar, and that tab will pop up. And then here is the magic. Here's where everything begins. I want to have a look only on the US dollar. So I click on the globe here on the little earth, click on US, and then leave on medium and high impact. And then I will click on this week so I can have the broader overview. And there you go, Wednesday. That was yesterday for me, Australia. If you are in a different time zone, you can pick over here. You have plenty of areas, just depending where you're at. And then let's have a look at this one. So United States core inflation, the inflation rate month over month came in to be 0.2% from the previous 0.3%, from the forecast 0.3%, from the previous 0.5%. Well, that's a big decline, right? We're talking about 0.3% decline into the inflation in less than a month. So that's pretty good. Of course, below the forecast, 0.3% came in 0.1% below. Yes, it's good, but it's not enough for the market, okay? And we're going to have a look at that very soon. So the inflation is, for those who don't know what's inflation, basically inflation is a measure of how much the prices were costing on last month or last year or last quarter or last, 10 years, and how it's costing now. And the Federal Reserve has been very aggressively raising interest rates over the past 2 years to bring inflation back under control. And the latest inflation report that we just have it now showing on my screen suggested the prices increase on a lower pace than what was expected. which initially seems like good news, right? We look at that and think, oh, that's fantastic. But to truly understand why the inflation came in lower, we need to look at the underlying factors driving this decline. So one of the main contributors to the lower inflation print was the slowdown on housing and rental prices increase. Luca, how do you know that? Easy, my friend. Coming to bls.gov/CPI slash, slash, there you go. And there you go. You're going to come to this website. I'm going to send it over to you on the chat. See, so easy. I even send the links for everyone, so no one has to be going around. Now, that's the BLS, the Bureau of Labor Statistics. They are the ones that collect and express the data from US. So basically, for us to have a report and see what actually came up, what actually came down, whatever. First of all, there's the very clear here, CPI for all items rise 0.2% in February, shelter up, gasoline declines. So let's have a look on the HTML. And let me take this off. Perfecto. Okay, cool. So this, is anyone trying to join? No. So that's the table of changes in the CPI for all urban consumer prices, okay? And as I say, one of the main contributors to the lower inflation print has been the slowdown in housing and rental prices increases. And shelter costs, which make up a significant portion of the inflation calculation, they have been moderating, okay? So if we look here at shelter, right on the end, we can see that it doesn't change much, okay? It has been on this path since August 2024. It is not volatile as like food and energy, because you can see food and energy is really volatile. One day was minus 1%, and then minus 1%, and then minus 0.2, and then positive 0.4. And then 2.4, and then 1.1, and then 0.2. So that is very volatile, okay? Same go for the food prices. If we look at food prices, they are a little bit volatile. You see like some big jumps across those three lines, the white, blue, and white here. These are volatile items, and that's excluded from the core CPI. Core CPI don't include energy and food prices because they're so volatile, and that's something that the Fed can't control on the interest rates or whatever they want to do, open market operations or whatever. But anyways, as I say, the shelter costs is making a significant portion of the inflation calculation, and they have been somewhat moderating if we look back into August 2024. This is partially due because the lagging of the interest rates rate hikes, which have made it more expensive for people to buy homes, and that reduced the demand in the housing market. And as a result, the rent growth has slowed down as well. So there's no more houses, a lot of people want to be able to afford. They're going to have to be getting the property back to the bank, and that's how it goes. Another key area that I can look at it where the inflation has cooled is the energy sector. So as I say, the energy sector is very volatile. But if we look at here, from January 2025 to February 2025, we had a huge reduction of pretty much 0.9%. That's insane, okay? Out of nowhere, boom, down 0.9%. Oil gas prices have stabilized. So as we can see down here, gasoline, fuel oil, and then energy services, they are somewhat stabilized around these marks, okay? Because if we look back to August and September, they're pretty much similar from that area, okay? So this is like the sort of normal for the oil gas prices. Anyways, so they had a sharp increase, I think was in 2022, if I'm not wrong, because they started on work in ACY in 2023. So yeah, that was in 2022, November, December 2022. We saw a huge spike. I think we don't have the TTMF anymore. TTFM, yeah, we don't have TTFM anymore. Let me just say gas, German gas. Maybe, yeah, I don't know why it's not available anymore. Yeah, but anyways, so you guys are gonna have to believe on me. The prices is spiked. Oh, I know how to find gas prices. German. There you go. That's the gasoline prices. Let's go 5 years. Yeah, so we had this huge spike. That's the gasoline price, but it's the same thing. You can find electricity, gas, but natural gas TTF here, but it's going to be exactly the same thing. So 2022, 6 months. Let's put in. There you go. So 2022, we had a huge move up. So the normal was like, this is 20. The highest was on 45, and then the lowest point was on 40. So that was kind of normal. Okay, sorry, 2020, the lowest point was in $2, 2 euros. And then over here, we had somewhere around 25, but then we had a huge move up to 240 euros per watt, okay, megawatt. So that's a lot, man. That's really big. And that time, for those who don't know, Europe has the winter closer to like December, January, February, you know, this period. And then we had like gas prices costing $250 per megawatt, 250 euros per megawatt. And then you think, I'm going to freeze because I can't turn it on my heater. So how am I going to supposed to live on that, right? Well, luckily enough, the weather came in to be much more cooler, much more warmer than what was expected to be. And therefore, no one died on the winter. You know what I mean? So it was a little bit better than what was everyone expected. So that was the 2022 thing. So I think they're sort of stabilized here, okay? So supply chain, which was severely disrupted during the pandemic on 2019, they have also largely recovered now, reducing the transportation and the production costs for business. And consecutively, that's not passing on to the consumer. And that has helped ease the price pressure across the board. So we are seeing somewhat of a fear of inflation, fear of, fear of recession. But so far, so good, isn't it? Well, at the same time, the consumer spend pattern, they have shifted. And that's where, like, I think you want to have a recession because of these. Lots of people are talking about a recession, but people, they have become more selective when it comes to searching or acquiring a product on the purchase. They're pretty much cutting back on discretionary spending because of the higher cost of living. And this has forced the business to slow price increases or even offer discounts to attract customers, contributing to the softer inflation reading. And I know that this is on US, but very similar thing, very similar pattern happening here in Australia. Australians are looking at the supermarket shelf more picky. They are being more like, okay, this we're gonna need, this we won't need, or last like 2015, things that were so cheap that you could buy for 2 months with $500 if you live alone, of course. And you could buy meat and everything. 1 kilo of minced meat now is $15. $15 is a lot. We're talking about $60 for like 4 kilos. $70 for 5 kilos of meat. So that's when you put that in perspective, people are being more selective. Like, I have to spend $15 to eat 1 week of meat, or I can buy $50 on like random stuffs. Well, no, I want to buy something that's going to make me full. So let's go and buy meat. So they're being more selective. That's how I think that the market is being proactive at the moment. Okay, so how is this affecting the market? Well, normally when inflation, where's the US dollar index? Let me put this on the hourly chart. Perfect. Normally, when inflation comes in lower than expected, the market reacts positively because, it's suggesting that the Federal Reserve won't need to keep interest rates higher for much longer, isn't it? Well, my friend, one thing that we've learned on the pandemic is that my teacher from economic schools, he used to say, yields never go up or never go down. They're very stable, very, very stable. That's the safest investment you can ever do. Okay, cool. Look at that. Look at that. Is it? Well, not anymore. And that's the whole thing. The market has changed. Okay, the market has changed. This is daily. Let me put it into daily. The market has changed. Yes, it was like that in 2014, very stable. And then 19 was the COVID. And then since then, it's just a crazy thing, man. It was sort of stable. It was sort of okay. And now it's not anymore. So things change and make it clear, all right? It doesn't go any clearer than that. Anyway, so coming back here on the US dollar into the 1 hour. Perfect. So as I say, when inflation comes in lower than what was expected, the market sort of reacts positive because it's suggesting that the work that the central bank, in this case, the Federal Reserve, has been putting in, it's working, and they won't need to keep interest rates higher for much longer. Basically, low inflation often leads to expectations of rate cuts. We all know that, which typically boost stock prices and weaken the US dollar. However, this time, the reaction is a little bit more complicated and a little bit more different. So despite this low inflation data that we had yesterday, this market didn't react to that bad figures, which got me roasted and cooked at the time, even with the last NF. Yes, that's correct. I agree with you, Sweets. So as I say, even with the low inflation that we had, the bond yields have remained very volatile. And the stock market have been experiencing some very choppy trading, like ups and down, ups and down. And this is because the investors are now questioning what this means for the future economic growth. If inflation is falling so quickly, basically that could be a sign that the demand is weakening, which might indicate that a slowdown is on the horizon. In other words, putting it another way, pretty much lower inflation is generally positive. It's falling for the wrong, if it's falling for the wrong reason, like a sharp decline in economic activity, it can actually be a warning sign. And if we look on the CME FedWatch tool, is pricing only 2 cuts for this year. Maybe 3 weeks ago, I showed this tool again for everyone. I've been going back and forth with CME FedWatch tool, but it's a pretty good tool. I can send it over for everyone on the chat. CME FedWatch tool. Done. So that's a pretty good tool. I mean, it shows the projection of the rate cuts or the rate increases or rate pauses from the Fed, and it's a market-based indicator. And remember, indicator, it's an indication of something. It's not a 100% thing, but that's pretty accurate, and that tracks the expectation for the Fed interest rates decision. Before this inflation report, we are at the moment for the next one that is on the 19th of March next week on Friday, if I'm not wrong. Is it Friday? Can't remember. 17, 18, 19, or Wednesday. So that's going to be on Wednesday next week. We have the Fed. But before this inflation report, the markets were pricing the possibility of multiple rate cuts in 2025. Okay. Now, even though the inflation came in lower, remember what I just told you? If inflation comes lower, that is a good sign that the rates won't be holding longer, higher for longer. So the central bank can continue to cut and do the work pretty quick. Well, now it's suggesting only 2 rate cuts are likely. And why is that? Well, let's have a look. 19th of March, 97% of the market is expecting no changes. The current rate target is 425, 450. So no changes, 425, 450. On the 7th of May, 70.3% of the market is expecting no changes again, 425 to 450. 18th of June, 58% of the market is expecting a 25 basis points reduction to 4 and 425. July, no changes. September, 125 basis points cut. October, no changes. And December, no changes. 350, 375. Let me check. Oh, yeah, they are expecting one more cut. Okay. Now, the main reason is that the Federal Reserve remains very cautious about the inflation. And the Fed officials have, Jerome Powell, Raphael Bostic, everyone have repeatedly emphasized that they need to see sustained progress on inflation decrease before they are comfortable of cutting the rates. While one softer inflation report is encouraging, that doesn't necessarily mean that inflation is fully under control. And I've mentioned that many times here. The Fed wants to avoid a situation where they cut rates too soon and then they see inflation spike up again. Okay? So they have to be very, very cautious on that. And additionally, the job market last week on Friday, it remains very strong. Low unemployment, higher than expected, but still low. Steady wage growth. So the labor market still is very strong, very good at the moment. But if the labor market remains very tight, it could keep upward pressure on inflation. And that's going to make the Fed hesitant to ease the policy too quickly. The market's now pricing just 2 to 3 rate cuts instead of more, because investors believe the Fed will take a gradual approach and they will be waiting for more evidence before making any major moves. And then it comes up to be recession fears. What are we heading for? An economic slowdown? Are we heading for economic slowdown? That's my next topic. Are we heading for an economic slowdown? Well, one of the biggest concerns that everyone has been talking about on the market this week is the US economy heading for a recession. We have the inflation cooling. There are some signs of the growth is slowing as well, but this is making people nervous, and a lot of the Nasdaq's falling, S&P 500 is falling, Bitcoin's crashing, everything is going south. So if we go here, Nasdaq's falling. If we look at S&P 500, it's falling as well. Bitcoin has a big correlation with those two ones as well, is falling. So lots of things happening, right? So people are thinking geez, we're gonna move into a recession, and that won't be good. One red flag is the inverted yield curve, which has been a very reliable predictor of recession in the past. Basically, when the short-term interest rates are higher than the long-term rates, so let me do that for you. So we go here, and then we get the 10 years, for instance. And then we add in the 2 years. I don't have the 2 years here. US 02. US 30. So we have here the 10, the 2, and the 30. Okay. Let me see. US yields. 10 years, 2 years, 10, 1 year. Perfect. All right. So we have the 1 year, the 2 years, and the 30 years. Okay. So the short-term interest rates, if they are higher than the longer-term rates, it often signals that investors are expecting an economic slowdown. And this inversion has persisted for months now, since like October, pretty much, we can see there. So this is adding to like a recession fear. And another concern is that the weakening consumer spending data, we saw that the consumer is not too willing to expand, even with the job market still strong. There's signs that the consumer are starting to feel the strain of high interest rates and the elevated costs just now. And remember, every rate hike has a 6 month to 9 months period to be hitting the economy. I think I've mentioned that a few times now. But anyways, credit card balances are rising. And there's a lot of delinquency rates, are ticking up. And that pretty much suggests to me that some households are struggling to keep up with their expenses because things are more expensive. So if consumer spending pulls back significantly, it could drag down overall economic growth. Because remember, who makes more? So the consumer pretty much gets it. If consumer is spending more, then the business will have to produce more. And if the business are producing more, that's a good GDP, or that can go wrong as well. But the business, that's the point of the problem. The business are also becoming more cautious because the corporate earnings, they have been very mixed, with some companies, warning about slowing demand, business cutting back on hiring and investment, and that could further slow the economy and increase the risk of a downturn. Now, what should us traders look next? Well, with all of the uncertainty on the market, the next few months will be critical. Very, very important for us to be able to determine the direction of the economy and as well the indices, the Forex market, everything. So there's a few things here to be watching. First of all is the future inflation reports. So if inflation continues to trend lower, that could reinforce expectations of rate cuts. But if it remains sticky, the Fed might hold the rates for higher for longer. Okay. The second point is the employment data. If we have a weakening job market, that would increase the likelihood of a recession. And if we have a strong job market, that could keep up the economy very resilient. So it's pretty much the job market is holding the whole. It's like job market holding all of the economy situation on the US pretty much. And then not too important, but for those who trade indices and stocks, corporate earnings is very important. Companies' outlooks on consumer demand and profitability, that definitely will provide some valuable insights to the health of the economy, because if people are buying, then we know. If people are not buying, we know. So those are the types of things that we will need to be paying attention. And of course, the Federal Reserve, lots of meetings next week. We're going to have one on the 19th. What's the guidance? What's the tone? What's the tone of the guidance? How the expectations for rate cuts, how the economic conditions, what they're talking about, future rate cuts, forward monetary policy. all of those things will definitely make a lot of effect into us, okay? So to wrap things up, as we know, the latest inflation data came in lower than expected, but the market reaction has been mixed. And usually it's very, negative for the US dollar, but US dollar didn't even chint, they didn't even moved. So the market reaction has been, mixed because, of course, the concerns about economic growth and the uncertainty over the policy from Fed. We saw that the CME FedWatch 2 is pricing in only 3 rate cuts, and that is reflecting the Fed's cautious approach, maintaining higher for longer. And recession fears are growing, but there's some signs of slowing consumer spending. But I don't reckon we're gonna actually get into recession. I think those pullbacks on Nasdaq, S&P, Dow Jones, any indices, indexes, they're pretty good to be longing those. Not on trading, not on speculating, but like being an investor and building a portfolio on top of those types of assets. They're pretty good, pretty reliable. We know that from 100 years, hundreds and hundreds of years, S&P 500 have been giving 10% annually return. So that's pretty good. I reckon it's a pretty good overview. I think it's, Trump wants to get in as well, so that he's bumping down everything. But again, it's a very complex environment. Investors need to stay informed. They need to be looking at the headlines. They need to be adaptable as well, keeping an eye on inflation, employment, the Fed policy, and that will be the key for the next few days. Okay, guys, thank you so much. I hope everyone have a beautiful weekend ahead. Today's Thursday, beautiful sunny day here in Australia. I hope everyone is having a nice week. And thank you again. Thank you for coming. Thank you for staying with me. Appreciate your time. And see you back on Tuesday. Thanks so much, everyone. Have a lovely day.